watching Fight Back, are you thinking of investing in a debt mutual fund? Well, before zeroing in on your final pick, do remember that debt funds come with many risks and charges that could impact your returns. Saloni Shukla decodes this financial product.
Before you decide to invest in a debt fund, do make sure that you know where such schemes primarily park your money in. A debt fund generally invests in short-term or long-term bonds, securitized products, money market instruments or floating rate debt. Before investing, keep in mind that investments in debt funds are exposed to interest rate risk. Generally, when interest rates rise, prices of fixed income securities fall, and when interest rates drop, the prices tend to increase. Your investments will also be impacted by the liquidity risk. This pertains to the saleability of a security in the market. If a particular security does not have a market at the time of sale, then the scheme may have to bear an impact depending on its exposure to that particular security. Your investments also carry a reinvestment risk. This is because the interest rates prevailing on the interest or maturity due dates may differ from the original coupon of the bond. In case of a reinvestment, your proceeds might get invested at a lower rate depending on the present interest rate regime. The scheme may be exposed to credit default risk, which means that the issuer of the bond in which the scheme has invested may default on payments. These defaults will impact your payouts.
I think it's very important for investors to, when they start investing in the debt fund, is to be very sure about their time horizon. The time horizon is very important, as I mentioned earlier, because the major differentiator is the maturity duration of the portfolio. Now, depending on the time horizon, one has to select the right fund. For example, if the intent is to park the fund for short term, maybe for a couple of months, one can look at ultra short term debt funds. If the intent is to invest for maybe 6 months to 1 year, then one can look at short term debt funds. And if one wants to invest for a longer period, let's say 1 year and above, then income funds can be looked at. And why this is important is because the debt funds will have a longer maturity duration of the portfolio. Now, if someone is investing in this kind of fund, let's say with a time horizon of 3 to 6 months, it is highly likely that he may experience a lot of volatility there, and the chances are either he may not get any return or may actually suffer a capital loss. The debt funds pay a dividend distribution tax. For individuals in this category, ultra short term and other debt funds, except liquid fund, it is 12.5 plus surcharge and cess. Now, if someone who were in the tax bracket of 30%, if he opts for daily dividend reinvestment, the fund will pay on his behalf the dividend distribution tax of 12.52, which is much less than tax he is required to pay. But similarly, if he were to opt for growth option here instead of daily dividend reinvestment, it will be treated as a short-term capital gain and will be taxed at the applicable tax rate. Similarly, if one is investing for a period of, let's say, 1 year and more, then again, in the investor who are in the higher tax bracket should look at growth option, because the long-term capital gain is taxed at the flat rate of 10%. Now, which means that if one were to get a return of 9%, then the tax is going to be 10% flat, which is 0.90. Post-tax return is going to be 8.10.
Also, before investing, do note the expenses that come with this investment. There is no entry load attached to your mutual fund. Your exit load can vary between 0.25 to 1% of the redemption value charged to the unit holder. But do remember that the asset management company reserves the right to change or modify the load structure subject to the limits prescribed under the regulations.
If one gets attracted by the return which are coming in the income fund these days because interest rates are going down, and if invests short-term money, one, the risk is of volatility. The second is, even if he's able to make some return and if he exits within 3 months or 6 months or thereabout, he might end up paying exit load, as I said, maybe ranging from 1% to 2%. On the other side, if you look at the fund which are meant for parking of funds, like ultra short-term fund, most of the fund do not have any exit load because they're meant to basically park. So making the right selection also can make a big difference even in terms of costs and expenses.
Let us now redress your